Equity Market Update, May 2020. After rising approximately 15% in April 2020, Indian markets ended slightly negative month-on-month in May 2020. The key drivers of movement in markets were the economic package announced by the Government of India, rise in trade tension between US and China, optimism around economic activity picking up on back of relaxation of restrictions across major countries, etc. The mid and small caps indices performed slightly better than large caps. The auto sector outperformed while banking was the worst performing sector. Performance of most other sectors was largely flat. Globally, most major indices delivered positive returns. FPIs turned net buyers in May 2020 after remaining net sellers for the last 2 months. FPIs bought equity worth $1.9 billion in May 2020. Total FPIs equity outflows in the first 5 months of CY20 was $5.4 billion as against inflows of $10.9 billion during the corresponding period last year. Net inflows in the domestic equity-oriented mutual funds stood at INR 5,030 crore in April 2020 compared to net inflows of INR 11,344 crore a month ago. In the first 4 months of CY20, total inflows in domestic equity-oriented mutual fund schemes stood at INR 34,028 crore. Out of the Q4 FY20 results declared so far, results of cement and pharma were better than expectations, whereas banks, NBFCs and power were largely in line with expectations. Results of auto, metals and IT were below expectations. Outlook. As on 31st May 2020, Nifty 50 was trading at price to earnings multiple of 19.3x based on FY21 estimated earnings and 14.6x based on FY22 estimated earnings. While multiples are reasonable, in uncertain times like the current one, limited reliance can be placed on the price to earnings multiples for gauging valuations as earnings are difficult to predict, especially for FY21. In our opinion, Indian market cap to GDP and price to book value are better indicators of valuation of overall market in the current scenario. As of end May 2020, the Indian market capitalization stood at approximately 58% of GDP based on 2021 GDP, a level last seen post-correction during global financial crisis in 2008-2009. The price to book value has also corrected sharply and is now trading at significantly lower than its long-term average. Further, it is worth noting that the gap between 10-year G-Sec and 1-year forward Nifty 50 earning yield has reduced significantly and it is now below 10-year average. This further indicates that equity markets are attractively priced. Markets thus hold promise over the medium to long term in our opinion. Further, recently, government under its self-reliant movement announced that it intends to divest the stake in CPSEs through strategic sale rather than through exchange-traded fund route. This should lead to better valuations of PSUs as regular supply of shares through ETFs was a big overhang on their share prices. In view of the above, where risk appetite permits, investors should use this deep correction to their advantage by increasing exposure to equity funds. At times like these, perceived risk is higher than the real risk. There is merit in increasing allocation to equities in a phased manner or in staying invested as the case may be for those with a medium to long-term view and in line with individual risk appetite. Equity investment should, however, be phased out over the next few weeks or months. Historically, it has been observed that investments made in tough times and around the period when FPIs are large sellers have yielded good returns over the medium term. significant rise in spread of coronavirus, adverse global events, sharp rise in crude oil prices, sharp moderation in equity-oriented mutual funds flows, delays in NPA resolution under NCLT, etc. are key risks in the near term. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.